Now that you know what a P/E ratio is and know how to calculate it, I would like to show you two ways that we use P/E ratios to value shares, to evaluate whether they're expensive or cheap. The first way to evaluate a company's P/E ratio is to look at its own historic P/E ratio over time. Now, if you look at the P/E ratio of Cashbuild since 2003, you can see in that nice bull market it went up, then it came down a little bit, and then again from 2009 started to go up. Just for interest's sake, these big drops in the P/E ratio is when they announce the earnings or the profits every 6 months. So you'll see that the P/E ratio was 18, but the results was very good, so the P/E dropped to 12, and they had a very good result there. Then the P/E starts rising again, and it drops when the results are announced. But if we look at a long-term chart of the P/E ratio, we can see that it is trading in November 2014, it's trading slightly above the mean, the long-term mean, but it's still within one standard deviation. So it is expensive territory, but not very expensive. I would be more worried if it was trading in the upper levels there. I mean, that 2006, it was very, very high. But at this level, it's not cheap, but it is also not very expensive, so it's not worrying at that stage. The second way we use P/E ratios to evaluate shares is to compare it to the All Share Index or to peers. Now, this is a comparison chart of Cashbuild compared to the JSE All Share Index, just to see how it performed against the P/E ratio of the All Share Index. The red line is the P/E ratio of Cashbuild. The blue line is the P/E ratio of the All Share Index. You can see at some I've made the scales the same, so the scale, left-hand scale and right-hand scale is exactly the same. You can see that Cashbuild traded at about the market P/E ratio in those years. Then it traded slightly worse, especially here in the recession time when building was not that active. It started to grow again and traded above the All Share Index P/E ratio there. A very good reason was that it had big profits built in. You know, whilst the P/E ratio is historic in nature, you can also look, if you have forecasts of earnings going forward, you can use a forward P/E ratio, and you would have seen then that the P/E ratio was actually there and not there. It was a bit lower if you include the next earnings announcement. Now, you can get research reports on the Sanlam iTrade website. If you're a client, you can get a lot of research reports, and there's forecasts of earnings in that. At the current time, or in November, you can see that the P/E ratio was quite a bit cheaper than the market P/E ratio or the All Share Index. So Cashbuild looked quite good, and is maybe worth to buy. Now, if we look at peer group comparison, we took the banking sector, all the banking shares, and we got their price earnings forecast there, and you can see there which are the shares that are expensive and which are cheaper. If you look at a 1 year at the current forecast, Barclays Africa or Absa is at a current P/E ratio of 12. That will drop to about 11.5 according to analysts, and to about 10.5 in 2 years. Capitec is quite a bit more expensive, but you can see the growth is also bigger. The earnings growth expected is also bigger. It drops faster. And so you can look at the other banks and see which ones are expensive. Obviously, there are reasons why some banks or some companies have higher P/E ratios, and that is normally if you expect higher earnings growth from them.